Hello friends, welcome to Business India. CA Angad Pal Singh once again. Thanks a lot for appreciating my last video. NRIs selling property in India can save TDS. I got lots of appreciation. I got lots of comments, lots of messages, phone calls, emails, giving me appreciation for bringing out the detailed perspective on this topic. A lot of people are looking out in this topic because NRIs, they are staying outside India. They are not aware about the Indian tax laws, and they do not have much sources to know about them, in fact much reliable sources. So this video got a lot of attention and I got a lot of appreciation, but simultaneously I also got lots of comments, messages, phone calls and emails seeking more clarification on this topic, seeking specific questions about this topic and bringing out specific situation in which the tax laws can be different. So I answered all those queries one on one, but I also thought of compiling all those queries and clarifications in this new video. So let's quickly start. The topic is same: NRIs selling property in India can save TDS. Now let's take a quick revision of the earlier video, although the link to the earlier video is given in the description. So if you have not seen that video, please go and watch it in entirety, but we will have a quick revision of that. And before going ahead with the content, let me give you a small disclaimer. Every information that I give in this video or in any of the prior videos on my channel, it is only as per my interpretation of the laws and my personal experience. Do not act without taking professional advice, without taking professional help. So the author, that is me, I do not assume any responsibility and shall not be responsible for any loss arising to you if you act based on the information on this video. Now let's quickly revise the earlier video. Yes, NRI selling property, the immovable property in India, they have to pay tax on the capital gain arising on that transaction. The buyer who are buying the property from those NRIs, they have to deduct TDS before paying to the seller of the property. How much is the TDS? The TDS amount is 20% if the gain is a long-term capital gain and 30% if the gain is a short-term capital gain plus surcharge and education cess. Now it is 20% or 30% depends whether the gain is long-term or a short-term capital gain, and this 20% or 30% is applicable on the full consideration. Now let's say the property is being sold for 2 CR and the indexed cost of acquisition is 1.5 CR. So ideally the 50 lakh is the gain, and let's say it's a long-term capital gain, obviously that's why indexed cost of acquisition. So on that 50 lakh, 20% tax is 10 lakh. So the NRI seller is ideally is actually liable to pay 10 lakh rupee tax on this particular transaction, but buyer is liable to deduct 20% TDS on the full amount, that is 2 CR. So that means buyer will deduct 40 lakh rupees TDS and deposit it to the government on the behalf of the seller. Now the actual tax liability was 10 lakh, 40 lakh is deposited. So how does the NRI get the refund? Very simple. NRI can file the income tax return, show the detailed calculation of tax, 10 lakh rupees, take the credit of 40 lakh and get the 30 lakh refund. But this is a lengthy process. It will take around 1.5 years for the actual refund to get credit into the account of the NRI. So what is the second option? The second option is upfront, before entering into the transaction, get the lower deduction certificate from the income tax officer. How do you get that? File a simple application with the supporting documents showing the calculation of the actual capital gain, looking at which the income tax officer, after getting satisfied, will issue a lower deduction certificate to the buyer of the property and tell them to deduct TDS to the extent mentioned in the certificate, which would obviously be the actual tax liability of the seller. So that would be rupees 10 lakh in the case that we discussed. So this is what the video was all about. Now I have got lots of queries and clarifications. Let's quickly start with them. The first question I got repeatedly was, how do we determine whether the seller is a resident or a non-resident, NRI? So it is not determined by passport, it is not determined by the citizenship nor by permanent residency. Whether or not the seller is a resident or non-resident depends on the period of stay of that person in India. It is a detailed rule that is given in section 6 of the Income Tax Act. I have documented it, and the link to the document is given in the description. Now the buyer should not believe that a person is a resident or non-resident merely on the basis of Aadhaar card or passport or anything. It depends on the period of stay. Now, will the buyer, sit and calculate the period of stay? No. The buyer can simply take an affidavit from the seller, where the seller will declare whether he is a resident or a non-resident, and the seller must take a professional certificate, a certificate from a professional, before actually giving that declaration. So I think this answer is sufficient. The second is when the seller is determined as resident. Now let's say some person, although is a US citizen, but depending upon his period of stay in India, he comes out to be a resident. So what is the TDS that is to be deducted? In that case, if the seller comes out to be a resident, then only 1% TDS is to be deducted by the buyer, and that too if the sale consideration is more than 50 lakh rupees. Next, how do we determine whether a gain is a long-term capital gain or a short-term capital gain? Very simple. If the immovable property was held by the seller for more than 2 years, that is the difference between the date of sale and the date of purchase was more than 2 years, then it is a long-term capital gain, else it is a short-term capital gain. Now, why do we determine long-term or short-term capital gain? Because of 3 points. First, if the gain is a long-term capital gain, the tax rate is 20%, the TDS rate is 20%. If the gain is a short-term capital gain, the TDS rate is 30%. There is a higher tax if the property was not held for more than 2 years. Second is, there is another benefit, the indexation benefit. While determining the gain, you will obviously reduce the cost from the sale consideration. Now, in case of long-term capital gain, it is the indexed cost, the enhanced cost that is deducted from the sale. So, capital gain comes as a smaller amount, and resultant tax comes as a smaller amount. Now, what is indexed cost? This document is, again, the link is given in the description. You can see how the indexed cost is calculated from the cost. And the third is, in case you are having a long-term capital gain, you can also avail the benefit under section 54, 54EC, 54F, wherein you can invest the gain in a new residential house property or in capital gain bonds and get your capital gain totally exempted. So this is the benefit of having a long-term capital gain. So we need to determine whether the gain is a long-term or a short-term capital gain. Now, few people asked, now this is not law, but they asked for, you can say, justification, that why, if the seller is resident, only 1% TDS by the buyer, and why if the seller is non-resident, then 20 or 30% TDS, why is there so much difference? So let me first give this clarification that it is only about the TDS, not about the actual tax. The actual tax remains same for both. They have to pay 20% or 30% tax on the capital gain portion, whether they are resident or whether they are non-resident. But the buyer has to deduct TDS at 1% if the seller is resident and 20 or 30% of the seller is non-resident. In case of the seller is resident, he will determine his tax liability as 10 lakh rupees, take the credit of 1% TDS deducted and pay the balance tax liability. Whereas in case of non-resident seller, he will calculate the tax liability as 10 lakh, take the credit of the 20% TDS and get the refund, right? So tax liability, there is no difference. Why TDS difference? Because ultimately the government has to, recover the tax amount. So if the seller is a resident, so government thinks that the person is in India only, so and he is a frequent visitor to India, so in case he does not pay the tax, we can recover that from him. Whereas in case of a non-resident, it is quite difficult for government to recover tax from them, so they want upfront the entire tax to come into their account even before the seller files his income tax return. So this is a justification. This is again my personal perception. The government's perception can be different. Now, few people asked about what is the process of getting a lower deduction certificate. Very simple and online process. You have to file form 13 on the Traces website of Indian government. You have to give the calculation, detailed calculation, the computation of the income and the supporting documents. But before doing that, you need to have the buyer identified, because the lower deduction certificate application is buyer specific, right? So you have to identify the buyer, have an agreement to sell with him, and the buyer must hold a TAN number, tax deductor account number. This TAN number requirement is not there in case the seller is resident and 1% TDS to be deducted. But in case the seller is non-resident, the buyer needs to hold a TAN number. So if the buyer is not having a TAN number, there is a simple application in Form 49B, which you can find on NSDL website and get the TAN number in like 7 to 10 days. So once you file Form 13, the application for lower deduction certificate, the income tax officer might issue some questionnaires asking for more clarifications or more documents. You keep on replying to it, and there is a 30 days limitation in which the officer will either accept and issue the certificate or reject your application. Now this period of 30 days of limitation is kind of a little bit like delayed or ignored due to COVID in the current situation. But most of them are getting issued. If not in 30 days, then around 45 or 60 days. This is again my personal experience. It might be different for different people. Now another question was about capital loss. What if the the seller has incurred a loss in sale of that property and not a gain? So in that case as well, you have to apply for lower deduction certificate, because the buyer is liable to deduct TDS on the entire sale consideration without considering the cost. So you have to apply for lower deduction certificate, but in this case it will not be called lower deduction certificate, it will be called no deduction certificate rather. So there is not much difference in the process. Another point is whether you require Form 15 CA CB after you have got lower deduction certificate. Yes, indeed, the banker will not repatriate your money to your foreign account without getting Form 15 CA, which is your self declaration, and Form 15 CB, which is the CA certificate, which actually certifies that whether this money that you are repatriating is a tax paid money. So you need 15 CA and 15 CB, which is again a very simple process that is to be filed on the income tax e-filing website. Another question was, what if the seller deposits the tax directly to the government without buyer deducting the TDS? See, this is if the seller directly deposits the tax, it is called advance tax and not TDS. And in this case, the seller will have to issue Form 26A to the buyer. This Form 26A is to be certified by the chartered accountant of the seller that the seller has already deposited the tax on this transaction and the buyer need not deduct the TDS. But again, this is a matter of litigation that whether or not this is applicable on a non-resident or not. Another question was whether the non-resident can avail the benefit of Section 54, that if they invest the capital gain amount in a new residential house property, so can their capital gain be exempted? Yes, Section 54 allows all kinds of assessees, whether resident or non-resident, to invest the money in a new residential house property and get their capital gain exempted or reduced as the case may be. Now I want to give you a small case study in this. One of my clients, he is a US citizen, so he sold a property in India. The double taxation avoidance agreement between India and US says that both the countries can levy tax on that particular transaction of immovable property. So that means the property is located in India, so India will anyway levy tax on the sale of that property. But since the person is a resident in US, so US also levies tax on the income of its citizen, whether that income is gained in any part of the globe. So in that case, there is a double taxation avoidance agreement between the countries. So that means if you have paid tax in India on that property, you can take credit of that tax while paying tax in the United States. So this is, I think, the end of it. Yeah, there is one more clarification that was sought by the viewers, that what if there are joint buyers and joint sellers, like the property is being sold by joint sellers, there are like husband and wife or brothers who are selling that property, and likewise the buyers are joint. So in that case, every joint buyer has to deduct TDS of every joint seller. So lower deduction certificate is to be obtained by every joint seller against all the joint buyers. So you have to understand that. So let's say there are two buyers and two sellers, right? So there will be 4 TDS that will be deducted, right? A and B selling to X and Z. So there is a transaction between A and X, A and Z, and B and X and B and Z. So hope that clarifies all the points. Still, if I have left few things or you have specific situations, I am again open to all your comments, looking forward to it. Give the comments in this video, or you can simply email me at angad@singhapca.com, or you can simply send me a WhatsApp message at 9911515363 and I'll be happy answering to your queries in detail. Thank you very much for watching this video. I expect again a huge response on this video as well. Thank you very much. Thanks a lot.